So as we get started, there's a great team that we have here in place. So my name is Dr. Dustin Cheney. I'm the Director of Business Operations for Progressive Practice Sales. I've had the great privilege of working with Progressive Practice Sales as a client to start with. They sold the last 4 of my 6 clinics in Kansas and Nebraska several years ago. When they invited me to join their team, it was a real great opportunity for me because my passion for many years has been in helping doctors, and this really allows me that opportunity. Our company CEO and lead broker is Crystal Meisenheimer. She's below in yellow with the name that says Crystal. She'll be available to answer or field any questions that are more specific to the practice sales side and the implications that are here. But really, from all intents and purpose, our lead presenter today is Don Rasmussen and with Quartermaster Tax Services. So Quartermaster Tax Management is a proactive tax planning firm that creates tax-free income for their clients through research and development tax credits. They have a dedicated focus in the chiropractic industry. Quartermasters has recovered over $15 million in tax overpayments just in 2021, and has helped over 700 doctors recover their overpayments. Don Rasmussen, the managing partner for Quartermasters, is a seasoned tax and charitable planning strategist. Having worked with chiropractors around the United States, he and his team have guided them to claim research and development tax credits, make informed tax planning decisions, and help them to avoid costly mistakes, maximizing their savings, lowering their taxes, and really to find money falling through the cracks in their current tax and financial planning process. Don is the author of the top 10 tax subluxations chiropractors have and how to adjust them. He's a sought after speaker on the tax and financial issues market and has been a featured contributor in Chiropractic Economics, Dynamic Chiropractic, Forbes, Fox Business, and the Slot Report. I'm going to turn it over to you at this point in time, Don. If I didn't introduce Jonathan, maybe you can share just briefly who he is and why he's here.
Sure. Well, thank you, Dr. Dustin. I appreciate it. Yeah, Jonathan Hill is on here. He is my director of marketing. Jonathan actually has brought some great experience from another medical field. That's the dental, or pardon me, healthcare field. That's the dental. But he handles all of our marketing, all of our events. So we do about 75 events a year. So I'm sure we'll probably see some of your DCs at different states around the country, different coaching groups. So listen, again, thank you very much for everyone for being on today. And thank you again, Crystal, Dr. Dustin, for having us on as well. I appreciate it. So what we're going to talk about today is really unclaimed money. You know, there's around our area, about once a year, there's this thing that comes out in the newspaper that shows unclaimed money sitting in bank accounts and brokerage accounts and things like this. What I want to talk about today is unclaimed money with the IRS. And so, you know, as a chiropractor that you're selling your practice, the biggest thing you want to do with working with Progressive Practice Sales is how do you create more value? Well, of course, all these years that you've been practicing, that creates value, but another opportunity is how the IRS will help bring some more value when you go to sell your practice, as well as if you're looking to buy a practice, how you can take advantage of this as well. So whether you are the seller or the buyer, our motto is it's not how much you make, it is how much you keep. And that's really what we want to talk about today. I'm going to talk about 3 different things, make them real brief. And of course, you can get more information later if you like. The one thing I want to stress here is Quartermaster Tax Management, powered by your CPA. Our goal is not to replace your CPA. Our goal here is to do what most CPAs don't have the time or the expertise to do, and that is to go and take advantage of these 3 different programs we're going to talk about today. So I just want to stress that we're not here to replace your CPA. We work with CPAs all over the country. On our team, we have 5 CPAs and enrolled agents, accountants, 3 tax attorneys, and our focus is on how to get more money into the pockets of our DCs around the country. So again, this is going to be directed towards both the buyers and the sellers here. But in the beginning here, we're going to specifically spend a little bit more time towards the sellers. So if you're in the position of selling your practice this year or the years to come, you'll want to make sure you pay close attention to it. So the topic I want to start off with, first of all, is tax recovery. So this one here is where I speak mostly around the country is about how to go back and get money that you're entitled to and from the IRS. So when I look at that, we're looking at your 2019s and possibly 2018s. I don't want to get your hopes up. It all depends upon when you filed your taxes in 2018 will determine whether we can go that far back. But I know for a fact we can go back to 2019, of course, 2020, and then of course 2021. And then of course we would file amendments to take advantage of this here, this benefit called research and development tax credits. So research and development tax credits, to kind of simplify it, and then I'll get kind of deep in the weeds, is every time you see a patient that comes in and you do an assessment or you're doing a reassessment or reevaluation. So you have a patient comes in, you've determined that they have some subluxations or some other issues going on inside their body, whether that's a sciatica issue. This is what you're doing is you're actually looking at determining what is the problem. And then once the treatment or the care plan has gone into place, it's coming back and reevaluating. That is extremely, extremely important to make sure you meet the qualifications that the IRS has set out for that. So, and then of course, so I always tell my DCs, every time you see a patient that comes in, you do an assessment or a reevaluation, that's considered research under the section 41 of the IRS code. And every time you do a modality or care plan, that's development. So those activities are what they call QRAs, qualified research activities under the IRS. So the one thing I always want to stress about modalities, it's great to have decompression or laser or electric stem, but ultimately it's about utilizing it. So the more you utilize this, or your staff, your associates, your CAs, the more they're involved in utilizing these modalities is the greater amount that you're going to benefit from this process. So there's a 4-part test that meet the criteria for section 41. Number one, it's got to be technological in nature. So whether you're, let's say, for example, you do x-rays and you're, take a initial set of x-rays to determine what's going on. And then of course, a follow-up one later on. Technological could be as from the standpoint of utilizing, again, laser, decompression, anything such along those lines. Trial and error process is utilized. So as we know in chiropractic is that, for someone, one type of treatment the body will respond one way, and then for others another way. So this is, again, is very, very important. And all 4 of these, all my DCs qualify for. I just want to give you the 4-part test. Third is the goal of removing uncertainty. So because there's a trial and error process in place, then we have to come back and say later, what has been removed, what uncertainty. So once you have that in place, now you have your patient on a care plan that they're going to continue on over the next weeks and months and years to come. And then lastly, is the purpose is to improve performance and or functionality. All 4 of these things, as you can see, are definitely what a chiropractor does. Now, January 10th of this year, the IRS changed something that's very, very important when it comes to qualifying for R&D. So when we're going to go back and amend your tax returns, the one thing we have to do now is provide all of our documentation up front to the IRS to justify you getting that research and development tax credit. So what that does is a couple things. Number one, I like it from the standpoint that it's going to reduce the chances of an audit probably by 99.5% at least. And I say 99.5 because there's always a small chance they could come back later, but very, very unlikely. Just because they're approving this, that agent is reviewing everything and giving them the approval. We've not had any of our DCs declined under the new guidance, nor we have had any audits in the past. But the key here is all about documentation. So if I want to encourage you to make sure that as you prepare your practice for sale, is to make sure you're documenting that you're having this process in place, making sure that you're doing the evaluations and the reevaluations. I'm going to walk you through some of the actual activities inside these chiropractic practices that we've sent in this year here. And this is a very small amount. I mean, we have every DC's practices differently. So as this one here is migraine pain mitigation technique or back pain mitigation technique, the Schaefer conception protocol, the mechanical motion and therapy and ProSoft 360, Then, of course, we have things such as the chiropractic biophysics adjustment technique, or neuropathy, which is a big one, pain mitigation technique, activator, functional medicine technique, therapeutic phlebotomy technique, chronic pain mitigation technique, herniated degenerated disc pain mitigation technique. All these are different types of activities that are happening in these practices that have made them eligible for the research and development tax credit. Now I'm going to slow down a little bit and kind of talk about, if you're a seller, why is this valuable to you? Well, first of all, you've now created more value in your practice. So by going through this process and determining that you're eligible, then of course that's going to become money or a refund back to you from the IRS that you didn't take advantage of. That's why we call it tax recovery. We recover the money that you did not actually get, not any fault of your CPA or your accountant, but it's just the lack of knowledge in this area of expertise. So number one, let's say, for example, we go back and determine that you get the average of what our DCs do. So that's $24,000. That's $8,000 a year for 3 years. Now you have a $24,000 refund that you're going to get. So now you put that money in your pocket. But also, when you go to sell your practice, it's going to be much more appealing to somebody that they know that as long as they continue the processes, the modalities that you have done in the past, that they very well are going to be eligible for that same tax credit going forward. So now in this example, you have $8,000 additional value per year going forward that they're going to be eligible for, assuming they continue what you've done in the past. So that's where we see a great opportunity. And of course, if you're buying a practice, knowing that the practice that you have found out about through progressive practice sales, it has this credit in place. Now you know that it's going to help mitigate your tax liability going forward. So that's really where we see a tremendous amount of value there. Now, that all being said, these checks can get very, very large. I mean, this is Dr. Rodney White, $40,000. We have Dr. Frank Lombardozzi. His actually has gotten into six figures now, but when we took this picture, it's $85,000. And then, of course, Dr. Phil Galinsky, over $80,000 as well. So we've seen them, on the low end of $10,000, and we've seen them as, like, again, $150,000. I just had a DC in California, just got over $100,000 back for his 3 years. Now, keep in mind, there are certain states that are going to give you some R&D as well. Not all 50 states, unfortunately. There's only about 19 that do. And those states, what we call double dipping. So these are the states here: Arizona, California is a great state. North, meaning that California, you're pretty much going to get equal to whatever you received from the Fed, if not a little bit more. Rhode Island, Utah, Connecticut, Delaware, Indiana, South Carolina, Wisconsin, another great state, Alaska, Idaho, Illinois, Iowa, Kansas, of course, Dr. Dustin up there in Kansas, Maine, Nebraska, Ohio, Vermont, Pennsylvania, and Virginia. These are what we call double dip states, meaning that once we apply for the federal, we're going to apply for the state as well. It can be as little as maybe 25% of whatever the Fed gives you, to as much as 110% of whatever the Fed gives you. Indiana, another great state for that. So just so you'll know here that if you fall in any one of these categories, any one of these states, that you get the benefit of getting extra money from your state. So that's everything for research and development tax credit. So let me talk to those who are looking at buying, or even if you're not selling right now, but something to continue growing the value of your practice, is making sure, whether you're a buyer or a seller, but particular is looking at these top 10 tax subluxations that chiropractors have and how to adjust them. So I just want to say, I don't have time to go through all 10 of these, but I'm going to talk about the top 3. And why is this important? Because when you go to sell your practice, these are important, as well as if you're the buyer. I'm going to talk about the top 3 because this is extremely important, not from just a standpoint of value, but also from a tax planning perspective as well. So just so you'll know, there's about 85 different tax planning tools and strategies that are available to mitigate tax liability. The more money you make, the more sophisticated the planning gets. That's number 1. Number 2, if you're selling your practice, there are tools and steps that can be utilized to mitigate that tax hit as well. Because the good thing about selling your practice is you get this large amount of money that comes in, but how do we make sure that Uncle Sam does not become the biggest benefactor of that sale. So just a little side note, I won't go deep into that today, but we certainly can have that conversation. So the first area I see the biggest challenge is entity choice. So which entity should you be? So whether you're a seller or buyer, should you be a Schedule C sole proprietor LLC? Should you be an S corporation? Should you be a C corporation, a partnership? Those are the type of questions you need to ask, but which is going to be most beneficial for you and for the buyer in the future, and the easiest transition too. And I'm sure that Crystal and Dustin, they do give some guidance and direction on this, but we're going to talk more about the tax perspective more than anything, not the legal perspective. All right, second thing is reasonable compensation. So just so you'll know here, reasonable compensation is a big issue when it comes to the IRS. I've seen DCs who have made $300,000 a year and only showed a W-2 of $30,000. That itself is a large red flag, and more so in the future. So this is one of my doctors who didn't mind, because this is not saying how much he's taken as W-2, but this is what's recommended. So because he is in an S corporation, and because, as most DCs, every one of you wear multiple hats inside your practice. I have yet to find a chiropractor around the country that all they did was put hands on patients. The reality is you're going to be doing notes to keep track of what the treatment that has gone on with the patient. You're going to be taking care of staff. You're going to be taking care of maybe the restrooms or repairing something in the office. All these type of things, marketing. These are all have different pay values. And so we actually have a subscription to a system from the IRS and the Department of Labor that tells us, based upon wherever you're at in the country. So this time, Dr. Jim was actually in Middlebury Town, Vermont. And so this is based upon his geographical area, how much each one of these different responsibilities inside of his practice we looked at, and then determined how much from the Department of Labor, how much they would be paid per hour. And that's how we come to that $69,000. And this is admissible before the IRS. So what I find is either DCs are taking too little or they're taking too much. Taking too much, now you're overpaying on taxes. So again, making sure that you have a very tax efficient practice too, whether you're selling or buying is extremely important. So from a time sake, let's move on here. Last thing is not having a written tax reduction plan. I'm a big believer in chiropractic. I'm a big believer in making sure you have a care plan in place. But the reality is most DCs do not have a written tax reduction plan. So again, one of our DCs here, this is exactly what we do, is create a tax planning report, the steps on what needs to be done. And then of course, we actually do the implementation to make sure that you are mitigating tax liability. So if you are paying more than $40,000 a year in taxes, then it makes sense to look at this here. Again, we're not here to replace your CPA. We're here to come alongside. And it's kind of like a cardiologist would be to a general practitioner. We're that cardiologist. We're going in here and taking advantage of, according to the law and the guidelines of the law, to make sure that you're maximizing how much you keep of your money. So those are the two things from a tax perspective. A third one that we've recently added on for DCs, and this is important because, again, if you are buying or selling, this is irrelevant, because really it comes back to making sure you're taking advantage of things that are not publicized. Just like with what I'm talking about here, the IRS is not coming out to educate you, but we call this a public service announcement. We're here to educate you on what's available to you as a DC. The last one is grants. So grants is not a tax issue. This is actually another government program that most DCs are not aware that they're eligible for. So I'm going to walk you through the three most common ones. And then, of course, we have a great relationship with a specialist who works in the grant side. So first of all, is incumbent workforce training grant. So what this would be for is for training and upskilling your employees, whether that's maybe your doctors on how to maybe sell your services better. Maybe it's leadership training, whatever it may be. But this is actually grants that are paid by both the federal, the state, and sometimes counties that will do so. The next one is on-the-job training grants, which is for hiring and onboarding new employees, building new departments, posting job openings. So these are grants out there that most doctors, most business owners aren't even aware that they're eligible for. The last one is capital growth incentives. This one here is a little bit different. So if you're expanding, is where you can do capital projects, relocation. Like for example, our practice has exploded. We're looking at some new office space. And so when I was talking through this process with him, our specialist, he was saying, well, make sure that you look at 2 different counties. So that way they start bidding for you to come to their particular county. So fortunately, we straddle a county line here in the Charlotte area, but that, those are the type of things that we look at to see how can we maximize. And these are pretty significant. Some of these grants can get up into 6 figures on any one of these 3. So here's the key here is you have to be eligible for these grants. You have to have 3 things. Number 1, you have to make revenue. Number 2 is at least 3 W-2 employees. And lastly, have to be in business for more than 6 months. So those are the 3 criteria to be eligible for these grants. If you meet that, then you would be eligible. From research and development tax credits, I apologize, I forgot to mention this. You need to have about $250,000 in wages that are paid inside your practice, whether that's for you, the doctor, and or your CAs or your associates. So you need to have about $250,000 where it makes sense for us to go through this process. So $250,000 in payroll is kind of our minimum. The more payroll, the more opportunity there would be for credits, because these research and development tax credits are a percentage of your time. So the time that you spend in those modalities I talked about in the care plans and the assessments and reevals, that time is what creates that credit or that refund back from the IRS, because you're not manufacturing anything. It's your time, your expertise that's being utilized. So what next? Of course, I want to say I appreciate being on here today. So Dustin, do we want to take any Q&A? Do we still have time for Q&A?
We do have a few minutes left. I don't have any questions in the questions or chat box this moment, but if anybody does have any questions, I believe there's a way to raise your hand. Be glad to try and make that technology work.
So I'm putting up on the screen here just for if you would like to schedule, there's no cost for us to do the assessment for you. You can go to either scan this here with your phone, or you can go to the address there that you see there. And there's no cost for us to do a review to find out what you may be entitled to. And of course, make sure that when you do request your Love Chiro Hate Taxes t-shirt, we are taking these all around the country. There's become almost like collector's items. And of course, we would love for each and every one of y'all to have one. So when you schedule your appointment, just request from whoever you speak with to make sure that you get yours. Now, one last thing, let me explain to you the process. It's a 3-step process. Number 1 is to do an initial intake call with one of our team members to determine, make sure you meet the requirements, find out about your entity, and so on and so forth. Secondly, gather up documentation. And thirdly is to get on with one of our tax attorneys. And I want to say,